Welcome to Get Paid for Your Pad, the definitive show on Airbnb hosting, featuring the best advice on how to maximize profits from your Airbnb listing, as well as real-life experiences from Airbnb hosts all over the world. Welcome. We are your hosts, Josefa Kapadia and Jasper Rivers.
Get paid for your pad. 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 Get paid for your pad.
Hey guys, welcome back to another exciting episode of Get Paid for Your Pad. Today we have an amazing guest on the show. For all you people out there who hate dealing with the tax implications of renting out on Airbnb, although there may be some of you that love it, I don't know. But for those of you guys who are looking for an expert to turn to, we have that expert on the show today. It's a close friend of mine and Jasper's, and his name is Villamena, and he's been doing this for a super long time, helping all sorts of people. So without further ado, Vinny, welcome to the show.
Thanks, guys. You guys could just call me the online tax man. It makes it easier.
The online tax man. I like that plug. All right. So for the online tax man, before we dig into all the awesome tips and tricks that you have, why don't we dive into your background first? So why don't you tell us a little bit about yourself?
Sure. Well, I fell in love with taxes at an early age. When I didn't pay taxes when I was delivering pizzas. And but no, seriously, I went I used to work at PricewaterhouseCoopers, kind of did the whole corporate shenanigans, working in a big four firm and then working in a finance firm, and then really after a number of years kind of working for the man, decided to start this company of my own. So it's Online Tax Man. It's essentially a boutique CPA firm. We do tax preparation and planning and all that sort of stuff for Americans living abroad, and then just regular Americans as well that are living in the States, etc. And then also foreigners that are looking to invest in the States. So everything is essentially online, and we deal with a lot of people in real estate. Obviously, that's a hot market both in the United States and then Americans that are kind of trying to diversify and get some other assets outside the States. So so it's interesting. It's a big market. So see a lot of things.
And when did you start your company?
So I started back in 2010. So we've been going strong for 4 years. And then before that, working for the man.
I see. And I understand you've been growing pretty rapidly. I know you've added on a bunch of personnel and are starting to tap into different regions of South America. Is that right?
Yeah. So I focus on South America. I think part of it is just, it's a lifestyle choice. I love South America. I like traveling down there, and the people, of course. But we definitely have clients from around the world, just because, the virtual nature of our practice. So people find us or get referred to us from everywhere, but definitely have kind of a strong South American presence at the same time.
Terrific. Okay, now we've heard about your very impressive background. Let's dig in. Let's go for it. I know that Jasper has been dying to jump in there and ask you some questions, so I'm going to let Jasper take the wheel.
Absolutely. Vinny, thanks for being on the show. Let's start with a pretty basic question. Let's say that I want to start an Airbnb listing in the US and I'm going to make a little bit of money off it. How does that influence my tax situation?
Sure. So basically, once you start renting through Airbnb and you're a US citizen, right, or not even a citizen, let's say you either are a citizen or live in the US, etc., you have kind of a SSN or tax ID number, which again, Airbnb would essentially ask you for. And the reason they ask you for your SSN or tax ID number is because they are tracking the money that you're making on their site. And obviously the reason that they're tracking this is because they have to report to the IRS the money that the that their clientele, the people that have the actual houses, not the people that are renting, but the owners, that they're tracking how much money they're making, because at the end of the year, they're going to report to the IRS, and then the IRS in turn is going to issue to the people a 1099-K, right? And what this 1099-K is, it's really just a summary of however much money that they collected throughout the year, right? So let's say it's $20,000, and then it's up to the owner to also deduct all their expenses regarding the house and regarding with renting the property, right? So first off, the first thing, and this is the big thing that people don't recognize when they get that 1099-K, is that's gross. That's actually not even net of commissions. So the first thing you need to calculate is off that 20,000, and I forget what it is. You guys probably know, but it's like, I think 1.5% or whatever the commission is paid to Airbnb. You have to calculate that, and off the top you want to deduct that, right? Because you actually never really received that full 20,000. And then again, any other sort of expenses. If you had a cleaner, if you had to buy linens, you had to buy certain accessories. Maybe you had repairs, utility bill. All these kind of normal expenses that one would for any rental property. They would have to do it. Especially if it's if the home's actually owned by the person, then mortgage, interest, and property tax. If it's rented out by the person, then re-rented via Airbnb, then of course rent would be partially deductible or fully deductible, depending on that, how much time they rented it to the person versus lived in it. But again, I think the biggest thing for anyone that's kind of going to jump into this, especially in the States, is to start tracking their expenses, etc., so that they have some money, so they could deduct against the money that they have to recognize that they earned, that goes on file with the IRS, and essentially is kind of unavoidable as far as not trying to claim that, because the IRS does have those records, and they will come after people that don't report that income.
And so, Vinny, I know you mentioned that there's certain maintenance things that you can deduct. What about big expenditures like building a pool or remodeling the kitchen, something like that?
Well, that could be partially. The thing is, so in kind of the grand scheme of how one deals with like real estate on their taxes, you kind of have to do it in two ways, right? One is like repairs and maintenance. So like something breaks, you fix it, right? And the other thing is kind of renovation and improving the value of the house. And anytime you improve the value of the house, like adding a pool or adding a renovation or new light fixtures, etc., that's not really repair. That's adding value. So you have to add it on to the value of the house, and then you could depreciate that value. So I don't know if you guys are familiar with the concept of depreciation, but essentially it's, you have a house, let's say $100,000. You're allowed to depreciate it over 27 and a half years. And that's a standard amount of time. It's 27 and a half years. Boom. No, you don't change that. And let's say the house goes from 100,000 to 150,000 because you added a pool and all these renovations. Then all of a sudden you're depreciating 27 and a half off the 150,000 and not the 100,000. So again, and then that obviously means that year after year your depreciation expense is higher. You get to deduct that against your income, and and then obviously you show less income or potentially even show a loss sometimes with the depreciation.
Right, Vinny. And one question I have is, does it matter if you rent out your whole house versus just one room? Because I can imagine if you're just renting out one room and you're renovating the kitchen, then I imagine you can't really you use that full renovation cost as an expense.
Yes, that's a great point. And that actually leads to another point as well, which is, you do definitely want to pro-rata it. Basically, if let's say you, and that it doesn't even apply to just renovation and depreciation. It can apply to anything, right? So, for example, let's say you own a house, and you're renting out a room. Let's say it's a 3-bedroom apartment, for example. You're renting out a room, and you have your depreciation, you have utilities, you have maintenance, and just kind of regular costs that we incur at living, right? But you're only renting out one room, and you're using the 2 other bedrooms for personal usage that you're living in, and with another roommate or significant other, whatever. So when it comes to kind of these group expenses, like depreciation, like utilities, maybe even the cleaning lady, if you're if the cleaning lady's cleaning your room as well, etc. You want to split these costs by 3, and you can only deduct a third of them because technically you're benefiting. You're still using the same electricity, you're still using the same Wi-Fi and internet expense. So you can't just deduct all of it towards Airbnb. You have to be reasonable and do a pro rata on what you used versus the tenants. Now, the other example of this sort of pro rata calculation, which is also important, is again, let's say you have a house. Let's say you're renting an apartment. Okay, but you're a frequent traveler. Let's say you're Dutch and you're traveling around the world, and your name is Traveling Dutchman. Just a random thought.
Random thoughts, right?
But point is if let's say you're living in your house half the year, and then half the year you're renting it out on Airbnb. Now, the expenses you incur throughout the year, like this depreciation. Like let's say you have to pay a monthly maintenance fee or a condo fee to the housing association every month, regardless of whether you live in there or not, et cetera, then you have to really do a job of tracking. And Airbnb, I think, does do this somewhat, but you have to do a job of, okay, out of 365 days in the year, how many days was my house rented? Mm-hmm. And then you have to kind of use that pro rata calculation to again kind of do a proportionate deduction of some of these kind of blanket expenses that you're going to pay anyway throughout the year. So those are two areas that you want to you want to kind of be able to do the calculation. You want to recognize that that's that's an important area to deduct.
Well, that makes sense to me. Let's say you're renting out the house half of the year versus the whole year, then you should only deduct like 50% of the maintenance on the house. And if you're renting out one room in a 2-bedroom place, then you should probably split the cleaning costs and stuff like that. So right. I think that's it's kind of like just common sense and what's reasonable is the guideline, I guess. And my next question would be, is this kind of the same, does this apply for all the different states, or are there big differences between states?
States are generally pretty similar. Obviously you do your Fed tax, and then you do your local tax, your state tax. There are certain nuances, for example, between states, and it's not as much with Airbnb, but for example, in Massachusetts, you could deduct rent against things, and there's certain credits, let's say, in some states for clean energy improvements, etc. So, I mean, there are certain nuances, but they're frankly more general to like homeowners in general, not anything very specific to to renting out your place as a cash flow investment.
Okay. Now, Vinny, we understand that you have a lot of clients that you work with who purchase homes and apartments abroad now that are American, but purchase homes and apartments abroad for the purpose of renting them out on Airbnb. Like, where have you seen clients primarily invest, and what regions, what areas of the world?
Well, we work a lot in South America, so I see a lot of people renting out and making cash flow in Medellin, Colombia, Panama is another one. Of course, people that go in Europe and are able to be successful in renting out in some of the main tourist destinations in Europe.
What do you think, and what do you think ties these locations together? For example, you mentioned Medellin and some other places. Why do you think these particular regions are attractive?
Well, I mean, I think when it comes to like Medellin, for example, there's kind of been a large influx of tourism to these places, and there might not be like a big short-term rental market, and especially not catered towards Americans or foreign tourists. And so that's where I see a lot of people coming and buying properties and renting it through Airbnb or trying to kind of market themselves through Facebook or maybe other avenues. So I certainly see a lot of people investing abroad, etc.
All right, so Vinny, I know that you, in doing this, you've come up with a cool little list, I'd say, of do's and don'ts for people who are interested in jumping into offshore real estate investing. Why don't you go down that list for us?
Sure. So I'll start with kind of the don'ts and some of the pitfalls I've seen. I think one thing is, you want to really, be aware of who you're dealing with, who's managing the property, etc. Right? Because I've seen Americans try and invest, especially in South American countries, and get burned, both from a in the buying process with kind of more and more fees, in the selling process as well, in the renovation process and renting it out, if they let other people kind of manage that.
So now, and these fees, are they imposed by the government, or essentially people are jacking the price up on them and essentially taking money from them?
It's a little bit of both. I mean, I think when it comes to like putting offers on property, etc., I've seen jacked up things. When kind of dealing with lawyers and the closing costs, I've seen kind of hidden fees all of a sudden come out. So I think it's kind of just very important to just be aware of what the fees are and what needs to be done, and then also have a trusted attorney present, from that native country to have to deal with it, so to speak.
Interesting. So, Vinny, I just thought of something I want to ask you.
Sure.
I know that a lot of people started looking into buying a house specifically for renting out an Airbnb, and I wonder, is there a difference between renting out long term versus renting out short stay in terms of your tax implications?
There's not really a like long term or short term. No, I mean, again, like when you look at kind of like, if it's, I think the big thing actually is, is the rental property exclusively for renting out, or is it for personal use as well, right? So, for example, let's say you buy a place in Medellin, do you go to Medellin half the year? Are you actually using it, or is it just in Medellin and you have to, if it's vacant, you're still incurring the same cost. You're not going to go use it, versus if it's occupied 100% of the time. And I think the reason is, again, if it's strictly for renting out, then you can pretty much deduct all these mortgage interest and maintenance and all these expenses 100%, just because you're still going to have to pay that if it's rented out or not, versus if you're using it for only half the year and then you're renting it out. But I think just to kind of get back to the offshore real estate investing, because there's a few points that I think are very advantageous for people who are again, Americans, let's say, that want to invest abroad, and kind of, let's say, just offshore assets and buy real estate abroad. Now, one thing to be aware of is that if you, let's say, you buy a house, but you buy it, let's say you don't buy it in your name. Let's say you buy it in the name of the company. Similar to like in the United States, both U.S. and foreign people, they're not going to buy the house directly. They're going to buy it through an LLC, and that helps, liability implications. So if, whatever, you have a tenant that cracks their head on the floor, they can't blame you and sue you for things, right? If you, let's say, you were to buy a house, again, abroad, but not in your name, in the name of a foreign corporation, all of a sudden, if that house is worth over $200,000, and you're, let's say, single or filing separately, there's certain thresholds, but let's use $200,000. Then you have to report that asset to the U.S. government because it's a financial asset. So you have to do what's known as a Form 8938. All right. So there's certain reporting requirements potentially for having foreign assets. The second thing that I think is important when you think about maybe investing abroad is you probably should set up a company abroad that owns the property or at least maintains the property. And you could do that because it's a certain tax deferment strategy that one could employ for any money that they're earning abroad. And generally how that works is, for example, you're getting $20,000 a year, you're spending $5,000 a year, so your net income from a foreign real estate investment is $15,000 a year. All right. Well, normally, if that was in the States, you'd have to recognize that income, you'd have to be taxed on it as such, so on and so forth. No implications on that. However, if you have a foreign company and you're renting it, again, kind of through the foreign company, you're allowed to retain those earnings abroad, meaning you're not repatriating, you're not bringing them back to the States. You're just kind of keeping that $15,000 every year abroad, and you're doing that again in the form of retained earnings. You're keeping it in the company. Let's say you're building up cash flow, or I should say just cash, to renovate that property later, or maybe buy a new property, what have you. Now, there's nothing wrong with doing that. And obviously, let's say that net $15,000 that you earn, you do not have to pay tax on that year. That's what's known as tax deferred, meaning, again, you could kind of keep on accumulating it, retaining it, keeping it abroad, and not pay tax on that money until you repatriate into the United States. So that's a very little known trick where you could essentially kind of defer paying tax, meaning you don't have to pay tax until you bring the money, into the U.S., or you could just keep on piling that money abroad, and then obviously, when you could spend it on renovations, you could spend it on buying a new house, etc., and then you're just deferring that money.
That is a really, really interesting tip and a great one that I hadn't thought of. So just to sum it up, it sounds like if you set up the foreign corporation correctly, as long as the money doesn't come back into the U.S., you can keep it separate and have it, as you put, tax deferred, where you're not paying U.S. taxes on that money so long as it doesn't re-enter the U.S. Did I get that right?
Yeah, essentially. I mean, you want to keep it in retained earnings. You want to have it for putting capital into the house and doing and maybe reinvesting it. And as long as you're not repatriating into the United States, you would be able to tax defer. I guess the only other point, which kind of gets back to asset declaration, is, of course, if that money is abroad and in a foreign bank account, if that foreign bank account happens to be over 10,000 US dollars at any point in time, you would have to report that foreign bank account, and that's what's known as FBAR, for a foreign bank account reporting. So that's another thing to be aware of as a U.S. person with foreign assets or foreign bank accounts.
All right, that is really, really cool stuff. So we've talked a little bit about, from the American perspective, if they want to do some offshore real estate investing, what advice do you have for foreigners who are interested in buying property in the U.S. to rent out as an Airbnb property?
Yeah, I mean, I think there's certainly a lot of foreigners doing that. I actually see a lot of foreigners, particularly coming and buying a property for Airbnb and other purposes. Airbnb, particularly in Miami, Chicago, and some of the major hubs, and then Arizona, and then for other kind of cash flow purposes. But there are a few things that foreigners should be aware of if they're looking to make money in the U.S. off Airbnb, etc. One being that, if you're looking to buy a real estate property in the U.S. as a foreigner, you want to make sure you have the cash, or you want to make sure that you have sufficient cash, because it's a lot harder to get a mortgage in the U.S. as a foreigner. Right? That's just kind of off the bat. But I think the interesting part is that if you make money in the U.S. as a foreigner, you have to pay U.S. tax. And this goes back to what I said at the beginning of the podcast, which is, Airbnb is going to get they're going to